The biggest things I would watch, one is global liquidity. Now, the potential risks to global liquidity are tariffs or anything that would spike the dollar. But that's offset by the fact that we have a president that generally wants higher asset prices, that would generally not want a super strong dollar because he would perceive it as going against his trade policies, and you would potentially even label certain other countries as currency manipulators if they let their currency weaken too much relative to the dollar. So these with some bumps in the road, I expect decent liquidity this year, which probably is supportive of Bitcoin and gold. And then I also look at things like kind of Bitcoin's own metrics. So when I look at, say, market value compared to on-chain cost basis, so market value versus realized value, I like to look at those types of ratios to see kind of how euphoric is the network. And so far, it looks nothing like prior major multi-year tops. It looks kind of middling in the road in terms of that metric. Similarly, when I look at, whenever there's a major bull run, there's like the HODL wave. So what percentage of coins haven't moved in over a year? And when you get a major bull run, that number starts to dip because you have a number of long-term holders that are up 5x or 10x or 20x in their position, and they start trimming into that strength, and new buyers are buying into that strength, and that eventually can exhaust new buyers. And the rotation we've seen is still smaller than prior major cycle tops. So when I look at in the Bitcoin space, it looks like that still has room to run. And then I generally expect, both politically now, there's some green lights on it, and then also liquidity wise, while there's potentially some bumps in the road, I don't really see like a major negative turn in liquidity, and therefore I generally expect that we probably will see higher highs in Bitcoin this year.
Bitcoin's performance has been weak recently, and for now, it's a waiting game. That's the latest update from renowned strategist and macro analyst Lyn Alden. Bitcoin initially surged after Trump's election win in November, but has since dropped around 20% following his inauguration in January. Investors are reacting to the economic uncertainty caused by Trump's trade tariffs and geopolitical tensions, which are shaking market confidence. The broader market is also feeling the pressure, with tech stocks taking a hit. The Nasdaq 100 experienced its worst three-day drop in 2 months, and investors are pulling back from risky assets in favor of bonds, driving the 10-year Treasury yield lower for 5 straight sessions. Bitcoin ETFs are also seeing record outflows, with the IBIT ETF losing $158 million on Monday, while the Fidelity Wise Origin Bitcoin Fund saw $250 million in redemptions. Overall, US-listed Bitcoin ETFs have lost over $956 million this month, marking the worst month on record for the category, according to Bloomberg Intelligence. Lyn Alden notes that liquidity is a key factor to monitor during all of this. While tariffs and a stronger dollar pose risks to global liquidity, Trump's preference for higher asset prices could help keep conditions stable. Market indicators suggest Bitcoin hasn't yet hit a major cycle peak, as on-chain data shows long-term holders are still holding strong. Historically, bull runs are marked by a surge in long-term holders selling at extreme highs, but that wave of selling hasn't fully materialized yet. While Bitcoin is facing near-term pressure, its future trajectory will largely depend on whether liquidity conditions remain supportive in the months ahead.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
I think that Bitcoin is still too small to be super relevant at a $2 trillion market cap. It's probably still too small. Any sort of decisions around strategic Bitcoin reserve are probably separately considered than trade for the most part. And so, while that could be certainly beneficial, it's certainly beneficial for Bitcoin price. And if I was advising any entity, whether it's a corporation, whether it's a family, whether it's a country, you'd be like, yeah, you probably should have some Bitcoin. If your goal is to maximize whatever thing that you're running, owning more Bitcoin is probably going to benefit you in the long run. So we'll see how that goes. If we look out long enough, then things like Bitcoin and having a Bitcoin reserve can actually affect some of these trade dynamics, because one of these solutions to having a structurally overvalued dollar and therefore a structural U.S. trade deficit is to instead have more international contracts and more international reserve stored in neutral reserve assets. There's basically two methods. One is you either have a more multipolar currency world. So you say, okay, so some reserves are in dollars, others are in euros, others are in Chinese yuan, and a couple other major ones, or excess reserves and storage are kind of held in gold or Bitcoin. And now the problem is that the current Treasury Secretary has specifically said that they want to keep the dollar as the global reserve currency. They want that sanctionability. And I think that's where there's some competition. You say, well, we want to reduce the trade deficits, even though the trade deficits are what supply the world with dollars to be the world reserve currency. But we also want to keep the reserve currency because we want to be able to sanction anyone we want. And those are kind of competing dynamics. Now, maybe, decades ago during the Cold War, it was more advantageous to have the global reserve currency than to not. But now that the negatives have kind of accumulated and are front and center in politics, in some ways, ironically, the downsides of being the primary reserve currency might be outweighing some of the benefits. It depends who you are. If you're the U.S. government, you want reserve currency because you want to be able to sanction anyone. If you're Wall Street, you probably want the world reserve currency. But if you're industry, you're kind of the one that's on the wrong side of this whole apparatus. And one of the solutions there is basically say, well, instead of all these countries storing excess savings in dollars, treasuries, and U.S. stocks, save them in gold or Bitcoin or other types of global assets. But that's more of a conscious trade-off that I don't think this administration wants to make. The prior administration didn't want to make it. So I think it's probably a longer-term process, and Bitcoin has to get much bigger before it really enters those types of discussions as a kind of a reserve asset at scale. Right now we see El Salvador holding it. We see the Kingdom of Bhutan holding it. Potentially some Middle Eastern countries holding it. But in order for it to be like this, massive reserve holding among countries, I mean, at least has to get, half as big or as big as gold. So basically have to add another zero to market capitalization. And then it actually starts kind of being really relevant as, potential alternative as like a large scale reserve asset. Well, I think gold's been benefiting the past few years because Bitcoin's too small. So when these countries want to, around the margins, de-dollarize at the sovereign level, gold is their obvious choice for savings that they don't need to be very fast, right? So they can hold them long term. The bigger Bitcoin gets, the more it starts to compete with gold potentially. Around the margins, I think it's already competed with gold a little bit, but actually I see more indications that it's competed with silver, platinum, and gold miners. Because if you're a hard money enthusiast and you have a bunch of options for things you could previously invest in, it'd be gold, silver, platinum, the miners. Generally, if you want low volatility, you go with gold. And if you're more bullish, you want that higher volatility. If you're more of a trader mentality or just want that kind of, you're more bullish, you go with the higher of all things. But now with Bitcoin, it's higher volatility without the operational risks of being a gold miner or, things like that. So I think that actually some of those higher vol hard money assets have been more directly impacted by the existence and growth of Bitcoin and to some extent the broader crypto space. If you start to get bigger and bigger with Bitcoin, then potentially starts to challenge gold more directly. Probably not for quite a while. And then even in that scenario, kind of like how gold is always like seen as like the hedge against some sort of major economic issue, you could see gold as like the hedge against some sort of major cyber attack or something. People, there'll still be entities around the world that say we want to have some analog wealth stored rather than, put every single thing on this network. So that it certainly still could be seen as like a backup option and just a different type of backup. So I still think that compared to the global bond market, gold can still grow into that, even as Bitcoin is on its flank, kind of growing into gold to some extent.
Bitcoin is still too small to play a significant role in global trade or as a reserve asset, but its trajectory suggests it could become more relevant in the future. Currently, countries looking to move away from the dollar turn to gold, a centuries-old store of value that offers size and liquidity that Bitcoin has yet to match. Governments prioritize control, and the U.S. remains committed to maintaining the dollar's dominance despite the economic imbalances it creates. The challenge for Bitcoin is that, while it was once seen as a hedge against these imbalances, its slow adoption at the sovereign level prevents it from being a true alternative. Bitcoin's biggest test will come when its market cap grows large enough to compete with gold as a global reserve asset. Until then, it remains a speculative investment rather than a strategic tool for nations. While some countries like El Salvador and Bhutan are taking early steps, widespread adoption is still far from guaranteed. Now, let's return to hear more from Lyn Alden.
It's partially why there's a disconnect between kind of the wealthy and the less wealthy, or the asset owners and the non-asset owners, because anyone who entered this period with a lot of assets and with a home, either that they own outright or with a fixed rate mortgage on it, they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the downgoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that sector. It's ongoing just sluggishness because people generally don't want to sell unless they have to, and people are kind of waiting to buy and kind of constrained from buying. And so I think that's contributing to the kind of the K-shaped economy that we see right now. And now that I kind of view it as range bound. So during the rapid increase in interest rates, this was a really powerful effect that was happening. Now I think it's kind of absorbed. We've seen, banks have kind of absorbed a lot of the initial unrealized losses they have. We have some of the really problematic ones got cleared out, but now it's just kind of slowly being absorbed into bank capital. And then also I think the same thing's kind of happening on balance sheets around, which is that now it's kind of range bound. So it's less of a, kind of a fast hitting factor and more of this background thing that's happening. And that's also why I categorize rate changes as so relatively inconsequential compared to other things, because one, it's fiscal dominance rather than monetary dominance. So whether or not you get extra several $100 billion in deficit spending or not is a much bigger impact than a few basis points. But then also the Fed cutting the short end doesn't necessarily translate to similar moves on the long end, which is where a lot of businesses and consumers are actually borrowing from in terms of new loan origination. It also, this kind of point to the kind of ineffectuality of the Fed here, because if you just kind of back up and say the Fed's tools to manage inflation are almost entirely geared around bank lending and exchange rates, basically. So if they raise rates, the goal is to kind of slow down bank lending, make borrowing more expensive, and also to harden your currency compared to potential foreign currency, so foreigners don't pull money out of your economy. So those are kind of the two levers. But in the current era, this entire 2020s period, we never had excessive bank lending. Bank lending was not the driving factor of inflation like it was in the 70s. And instead, we had monetized fiscal deficits. And raising interest rates doesn't do anything against monetized fiscal deficits. Now, they can push back on monetizing it to some degree. But at the end of the day, if they see dysfunction in the treasury market, they always step in to fix it. And so their tools are not really geared around that. And that's why it's ultimately more of a fiscal thing. Now, the Fed they can kind of indirectly tackle that by saying, well, if fiscal's running hot and is therefore contributing to inflation, we can run bank lending at below average to try to offset it. We can say, okay, if bank lending is normally at X, we can slow that down and maybe run at 70% of X. So you have a little bit sluggish bank lending and therefore slow down money creation that way. But then all you really do is shift where the driver of the economy is. You're almost kind of like unfairly slowing something down because fiscal's running hot. And so that's kind of the big challenge that they face. And it just kind of shows that the whole model doesn't work as well as it's kind of intended to when you have fiscal dominance, which is why this period is kind of just structurally, we need different ways of thinking about it compared to how we analyze markets for much of the kind of the past 40, 50 years. So I think it changed minimal. I think a lot of this is entrenched. A lot of this is demographics. A lot of the Social Security, the Medicare stuff is demographics.
The economy is increasingly divided, with asset owners thriving while those without struggle to keep up. High interest rates have benefited homeowners with fixed-rate mortgages and investors with appreciating assets, but younger generations and first-time buyers find themselves priced out. The housing market remains sluggish, as few are willing to sell and many are unable to buy. This dynamic has contributed to a growing economic gap, creating a system that rewards those with wealth while leaving others behind. Meanwhile, the Federal Reserve's traditional tools for managing inflation are proving ineffective. Rate hikes were meant to slow lending and strengthen the dollar, but inflation was never driven by excessive bank lending. Instead, it stemmed from massive fiscal deficits, and monetary policy does little to address this. Bitcoin was once seen as an escape from this system, an alternative to government-controlled money, but its adoption has mirrored that of traditional assets, benefiting early adopters while offering little relief to those struggling today. If Bitcoin's future continues to be driven by institutional investors and speculation, rather than financial freedom, it risks becoming just another asset in a rigged economy, rather than the solution many had hoped for.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.